and with startups in general. And really excited for the upcoming Utah Business Startup Summit. Nicole brings a great energy to the community here, and super excited to be in partnership with Utah Business on that. So thanks for joining the webinar today. We're going to talk a little bit about raising capital. As part of the upcoming Startup Summit, there is going to be a pitch competition, and I don't know that the finalists have been announced yet, but it's exciting to see. I think there will be 8 companies that will be pitching. But I thought this was really a great opportunity for all of the founders that wanted to join in to kind of get prepped on some tips and tricks when it comes to raising capital with confidence. And so with that, I'll just give you a quick little background on myself. As Nicole mentioned, I'm currently with a company called Forecaster, and we do financial modeling for early stage startups. Prior to Forecaster, I was with a company called Carta that also worked heavily with startup companies doing cap table management and providing software to make that easy for founders. I'm a founder myself, and so have gone through the process of starting and leading and selling a company. Have also worked with lots of different founders. I do a lot of angel investing and a lot of startup mentoring. So that's a little background on me. But as we jump into the topic here, I wanted to kind of set the agenda. And just so you know, we'll go through this, and then we'll open it up for questions at the end as well. So feel free to jot down your questions or even put them in the chat, and maybe we can go through those towards the end of the presentation here. But in terms of an agenda, we wanted to go through some of the key things when preparing for fundraising. The first thing is we'll talk about knowing your investor. And if you look at this, you can see there's a commonality of know your. You've probably heard the term very common in banking about know your customer, or KYC. Well, with fundraising, it's KYX. There's a whole bunch of things that you need to know going into preparing for your fundraise. And the first of those is knowing your investor. And then you need to know your numbers, know your equity, and stay on top of that. Know your pitch, obviously, and then wrapping everything up, putting everything in one place where it's nice and neat and provides you confidence to know that you've got everything you need to present to investors. So let's start from the top, and we'll talk a little bit about knowing your investor. So when it comes to knowing your investor, one of the things that I've seen a lot of founders misconceive, I guess, is that because venture capital firms or angel investors or private equity groups, because they have lots of money, that they should invest in your company. And it's just kind of a broad statement that, well, you have lots of money, so you should invest in what I want to do. Well, what a lot of founders don't realize is that when you're dealing with private equity groups or with venture capital firms or even angel investors in a lot of cases, is that they have a set thesis on companies that they do invest in. And a lot of times when you're talking to VCs, for example, they have strict agreements in place with their limited partners or the investors in their funds that determine what they can and can't invest in. And so just because you've got a great idea doesn't mean that you're a great fit for any investor out there. And you also might have certain angel investors where they won't invest in certain sectors. And so knowing that going into talking to an investor or doing your research on investors is really important, because otherwise you're going to end up wasting your time, but also the time of investors potentially. And so do your research on your investors. Know what things that they invest in, and what types of companies, and if you are a potential good fit for a given investor. And you might ask, how do we do that? How do we find out what types of companies investors invest in? Well, typically, if it's a venture capital firm, they're going to list their portfolio companies on their website, or you might follow them on LinkedIn and kind of get a good idea of the companies that they're investing in. If they're in a similar sector that you're in, if you're a B2B SaaS company and you're seeing that they invest in a lot of B2B SaaS company, that's probably a pretty good indicator. You'll also want to, determine what size of companies and size of checks that they write. So if you're going out as an early stage, seed company and raising, let's say $1 million, and you go to a venture capital firm's website and you see that they've invested in all these companies, but they've been putting in like $5 or $10 or $20 million checks, they're probably not a great fit for you. And vice versa. I mean, if they're writing smaller checks than what you need, there may be, or they're investing in companies at an earlier stage than where you're at, or at a later stage, then you need to know that going in. So do your homework, know the investors that you're talking to. The other thing you can do is, just as you're going out and networking, go out to some of these events where the investors are and get to know them on a personal level. And it will come up very naturally in terms of what types of companies they invest in, what stage they invest in, what size of checks that they write. It's a very natural conversation when you just start talking to some of the investors out there, purely out of curiosity on your part in terms of getting to know them and their fund. Okay, so the next thing is to know your numbers. Again, this is an area where I see a lot of founders, especially early stage founders, kind of struggle, where they might do what's called a top-down approach in terms of what they think that their market potential might be. And that's great when you establish a total addressable market and kind of get that to a serviceable, obtainable market that you think you can really capture. But in terms of your financial projections and what that means in terms of customer count and all of those types of things, you really need to take a bottom-up approach of how do we get to these revenue projections that your investors are going to want to see. Because when it comes down to it, most investors are really interested in what the potential of your company is in terms of your revenue and then ultimately your profitability. And so knowing what's going into driving your revenue is super critical. And you might be able to get past an early stage pitch deck competition with just showing kind of the classic hockey stick graph of starting out with very little revenue and then ramping up quickly to some big revenue numbers. But even if you get past the pitch deck phase and they don't drill into that, you can guarantee that on the next stage of due diligence, they're going to want to know, well, what goes into these revenue numbers? How many customers does that mean? How are you going to get them? So, diving into your customer acquisition model and some of the details there becomes critical. And what I've seen happen a lot of times is, you might get up there to present the company, and if you don't know your numbers, then you'll get asked questions about them. And that's not a place where you want to stumble when an investor asks you, what's your average contract value, or what are you estimating your customer acquisition costs to be, or what have they been historically? You want to be able to answer those types of things, right off the bat. And so in order to do that, you typically want to create what's called a financial model. And so a great financial model is going to tell you things like, how much money are you going to need to raise? That's an important, thing to know when you're going in and raising capital. The investors want to know that they're in line with, how much you're going to raise, and then how you're going to spend that money. And all of that can kind of be put into this model and show, how long your runway is, or how much cash you'll have once you raise this money to get you through to the next, inflection point in your business. You'll also want to go through your hiring plan. Who can you afford to hire and when? And what does that look like? What are your hiring needs going to be? this can all be mapped out in a good financial model, going through your customer acquisition channels, and ultimately figuring out how many customers it takes or how many widgets you need to sell in order to hit certain, revenue milestones. When a profitability, starts to, you might have a profitability target, and what that looks like, how much capital is going to take to get there. All of these things can be detailed out in a good financial model. So when we're talking about preparing a financial model, most startup founders aren't Excel gurus where they're putting in a complex financial model. And honestly, some of the worst financial models I've seen have been the most complex. You typically want to keep it simple but usable so that you can go in, adjust the assumptions, and run different scenarios. So there's some resources out there. Being at Forecaster, this was something that actually drew me to the company, was how helpful the software that Forecaster has is in helping early stage founders. And Forecaster has some free financial modeling templates. Happy to share those with folks if that would be helpful. There's also, Forecaster has a blog, but there's a lot of great resources out there about, being able to create a financial model and what it takes. And ultimately, Forecaster, that's actually what Forecaster does, is helps early stage founders create a financial model in a software platform that's easy to use. And with our partnership with Utah Business, we're actually able to offer a discount of 25% off the first year. So instead of being $2,000 a year, it ends up being $1,500 for your first year. And that includes building out a great financial model that will help you confidently be able to present to your investors and having that support behind that. So just wanted to give you a quick shout out for that. If you have any questions, happy to extend that offer. We'll also waive the implementation fees for you if that's something that will be beneficial for you. One other thing I just wanted to mention, this was something that I've been really passionate about with Forecaster, is creating something we call the Investor Connect platform. Once we have helped these founders create their financial model, and it's in the software, we've now got the historical financials, we know the revenue, we know the founder makeup, the geography, we've got the pitch deck, and all of this information is what investors typically need to know to kind of quickly screen through the companies. Well, we'll enable you to then opt into sharing this information with our network of about 100 early stage investors that are in the Forecaster network. And so that's another benefit, is you can opt into sharing that information with a broad early stage investor network. Okay, so one thing I did want to mention is that with your financial model and having a great financial model, it becomes table stakes or critical once you kind of are going into raising that Series A. Historically, you found that you might be able to kind of, fake your way through it or kind of get through it at maybe an angel stage or a pre-seed stage. Today, especially in the economic environment that we've got today, where investors are digging in much deeper with their due diligence and being more selective in the early stage companies they're investing in, we're seeing that a great financial model is essential even at earlier stages. And so at the very least, knowing your numbers and having a great financial model that you can walk through with your investors or potential investors is a huge separator for you at the earliest stages of your company. So something to consider there as you're preparing for your fundraise. And at the end of the day, it will also help you to know how much to raise and when to prepare to raise again in the future. Okay, so the other thing I wanted to jump into, the next phase, is knowing your equity. And again, this comes from my world. I saw a lot of cap tables when I was at Carta, and I saw a lot of really bad cap tables. I think there was a stat that was really interesting, that it was something like 80% of all cap tables that came through into Carta were not correct, had errors in them. And so, I mean, that's a pretty big concern. When you talk about knowing your equity, one of the first things is knowing how equity works, I guess, in terms of when you're divvying up the equity in your company, and knowing, how dilution works. When you bring in an investor, what is that going to do to your shares and the percentage of equity that you have in the company? And then being able to model things out and know what the impact of raising capital will do to you and your cap table. And so being able to manage, the equity and keep that up to date becomes essential for being able to project out the impact of raising, future capital rounds. So this is where it becomes really helpful to have like a cap table management software and a great startup attorney to help you navigate through all of this. A lot of times, especially early stage founders, you might go into capital raising with safes or convertible notes. And one of the tricks with that is that that's not necessarily equity today, but it's going to convert. The intent is to have that convert in the future. And so being able to project the impact of that, it becomes really important for you as a founder, and to your investors as well, on what does the pro forma cap table look like after you've raised, and these safes or your convertible notes all convert to equity. One of the mistakes I've seen a lot of founders make, and it comes back to haunt them, is they will stack safes on top of each other. And just because they first go out and think, okay, we're going to raise $500,000 or $1 million through a safe agreement or a convertible note. And then, additional investors come in and want to also invest, and they fill up the 500,000. They say, oh, well, man, we've got more people that want to invest. We'll just keep issuing more and more safes. And they don't factor in the impact of the dilution that can occur when they've got a really low valuation cap on the note or the safe. And so when they go to raise their Series A and their attorney goes through, creates the pro forma cap table with them, or maybe they model it out in Carta or something, then all of a sudden they realize that after their Series A, they've given up a ton of the company that they didn't realize, because they didn't stay on top of what all of this meant in terms of issuing out more and more safes or convertible notes. So being able to project all of that out is super helpful. And it's, as you're preparing to raise capital, just to know the impact of what the dilution is going to be for you and your previous investors is really important, because ultimately the new investors are going to want to make sure that you as a founding team and your employees that have stock options have enough left in the company to keep you incentivized and going through however many rounds of funding you're looking at potentially, doing in the future. So again, that becomes very important to stay on top of your equity and be able to model things out and prepare for your fundraising that way. The other thing I'll just emphasize here is make sure you have a good startup attorney. Too often you see, especially early stage founders who are bootstrapping things, where they'll have a sister-in-law that is a new attorney, and just because she went through law school, they will go use her, and she's never done a startup before. Well, startup law is very different than other types of law. And if you haven't, gone through the process and you're not familiar with how everything works, it becomes a real disadvantage for you in raising capital. It also sends a negative signal to your potential investors if you've got an attorney that isn't well-versed in startups and working with venture capital firms and startup investors. So make sure you have a good startup attorney. Okay, so the next thing we want to move on to is knowing your pitch, or building out your pitch deck. So there's a lot of different slides and things that you would want to make sure you have in your pitch deck. One of the things that I'll mention is I see so many presentations, and just a little background. A friend of mine, Tim Cooley, who's the author of the pitch deck book, he and I have started something called Pitch Us, where we have different founders come in and present their pitch decks and their presentation to us, and we give them feedback. And then we share that with the community to let other founders learn from that. Well, one of the things that we have seen so often is in these pitch decks, founders will leave out really important things that if they would just go to Tim's book, even the pitch deck book, then they would see that you have to have a competitor. There's a reason that you have a competitor slide. There's a reason that you emphasize your team and some of the things, and there's ways to do that. And there's reasons that investors want to see all of these things, and that's why you have some of these standardized templates. More than anything is to make sure you're not leaving out important things that are critical for investors to at least make a cursory decision on whether to take you to due diligence or not. And so you can refer to a lot of different pitch decks out there. There's a lot of companies that will share their Series A or even their seed round pitch decks as a reference point for other founders. Go out and research those, or go, get books like the one from Tim, or use other resources to see what other successful companies have done to raise capital and what they included in their pitch decks and how they presented things. Just from an overall standpoint, the other thing that you'll want to make sure on your pitch deck is, one, make sure you've got everything that you need. And you have, I can't tell you how many times I've actually gone through had a founder present, and they've actually left out the ask slide at the very end. And it's almost like having a joke and not having a punchline, where you're like, okay, so what does all this mean? This is great, but what do you need and why are we here? Don't make that mistake. Make sure you know, and it's clear what you're asking, what you need, and what your funds are going to be used for. Those are all things that investors are going to want to know. So anticipate the questions that investors will ask, and you can build your pitch deck kind of based off of those questions that you will probably get asked. One other tip I'll just give is a lot of times there will be different pitch decks that you'll want to create. So depending on the environment and who you're presenting to, it can impact your pitch deck, and you'll want to make it so that you can easily update and keep your pitch deck up and accurate and current. But also it's important to build out and practice different versions of your pitch, because you're going to get into some opportunities where you might have 3 minutes to present your company. Well, I can tell you, building out a 3-minute pitch deck becomes really beneficial for even your 10-minute pitch deck. And you might want to have a 7-minute pitch deck, because there's a lot of times where you'll have different opportunities to present, and there might be different criteria or different time slots. And then there might be opportunities where you have a full half hour or an hour to present to a company, and you'll want to have a presentation that is geared towards that. So go through and make a pitch deck that you can use for these different scenarios. But I will say that creating a 3-minute pitch deck is a great exercise, because it really helps you to hone in on what is critical for investors to make sure they get out of your presentation. And then you can also, it helps you to kind of figure out what might be missing in terms of the questions that get asked after something like that. And then finally, just practice. The more practice you can get at presenting, use things like 1 million cups or different opportunities you have to present to, whether they're investors or communities or groups. Take every opportunity you have, because every time you present your pitch, you will get better and better at it. Okay, a couple of quick resources. One, I already mentioned the pitch deck book, Tim Cooley's book. Would definitely recommend that. If nothing else, it will help you to make sure that you don't leave stuff out that is critical for your pitch deck, and run your pitch deck past, what is suggested in that book. It's a great resource. There's other resources out there like pitchpages.io that kind of walk you through an easy platform to create a great pitch deck, and it makes it easy to share with investors as well. Okay, so finally, once we've got all of this preparation done, you've done your homework on your investors, you've got your financial model created, and you know your numbers. You've got your cap table; it's all updated, hopefully in a nice and neat, presentation or platform. You've got all of your legal docs and all of this stuff all ready to go. Now it's time to put all of this stuff in one place that's easy for an investor to navigate and to see how prepared and on top of things you are. And so having a great data room is super important for that next stage of getting past the pitch deck and into the due diligence phase with your potential investors. I can say, if from an investor standpoint, the more put together you are, the more confidence investors will have in you. And so having a nice organized data room that when an investor asks and says, okay, can you send us over your pitch deck? And you send them a link to your data room, and it's got everything organized where they can not only see your cap table and your financial models and all of the legal docs, your stock option agreements, everything is in one place, and they can link and see all of this stuff. That definitely helps build confidence with your potential investors. And along those lines, one of the things that you're going to see, especially when it's early on, is in early stage investors are really taking a bet on you as the founder. They know that this business plan that you've put together and the pitch deck that you've created is not going to be 100% accurate. Your financial model is not going to be 100% accurate, but they love to see that you have thought through this, and they're looking for signs of confidence that you're the right person that can execute on this business plan that you've presented. And if things go wrong, you're going to be able to pivot and say, okay, we just learned from this, and what are we going to do to build upon what we just learned? Though the confidence that they have in you as a founder is probably going to weigh very heavily on the decision as to whether to write a check or not. And so the more confidence you can instill in your investors, the better. And having a platform, I'll just mention there's a couple of platforms out there that I'm very familiar with. I mean, Carta has a simple data room built in. There's a group called Savvy Legal that has a fantastic data room platform out there that makes it super nice and easy for investors to navigate, but it also gives you a framework to work off of to make sure you're not missing things as well. Okay, so that's kind of a quick wrap. One other thing I'll mention here is that we talked a little bit about some of these tools, and there's Carta and other cap table management solutions out there. There's Forecaster, there's different sales software that you may need as a early stage founder. One of the things I wanted to just kind of mention here is there's a place that I've been working on called the Startup Stack, and it's for early stage founders. And we're now up to almost $500,000 in different perks and discounts that are specifically for early stage founders. So if you are looking for different tools to help you run your business, Pitch Pages is on there. I mentioned them, for example, but even Divi and things like that. Go through the Startup Stack. Just go to mystartupstack.com, and there's probably a deal out there that you can get that is specifically for early stage startups. And so take advantage of things like that, especially when you're in that bootstrapping mode. And some of those things like Savvy Legal, we mentioned them. If you're going to get a data room solution, go through the startup stack and get a good deal on Savvy Legal's data room. If you need a cap table management solution, go through startup stack and get a great deal on Carta. You can probably even get it for free if you've raised less than $1 million. So great deals out there available and great tools out there to help you build confidence with your investors and actually kind of free up your time to focus on what's important in building your business. Okay, so that should wrap it up in terms of kind of where we're at. I did see there's a couple messages in the chat that have come in. I don't know if we have some questions, but Nicole, maybe you can kind of kick us off there.
Well, thank you so much, Jeff. Honestly, that was just a really great amount of information. It was so great. I was taking notes the whole time, so I hope everyone else was. But I had a couple of quick questions. I did want to remind everyone before we dive into the questions that there is a promo code for attending today's webinar. It's Forecaster, like Jeff at Forecaster. Forecaster 22, that's all caps. And if you need that, I'll drop it in the chat as well for the Startup Summit, and it will get you 50% off to attend. Yeah, go ahead and drop your questions in the chat and we'll monitor that as well. But I came up with a couple of questions that I had just from our brief little conversation so far. So I think the first one was, you mentioned so many great resources. It was amazing. But I think one that fascinated me is the one that you mentioned is called Pitch Us, correct? And that's something that you're personally working on.
Yes. Yes. I don't know.
Oh, go ahead.
Yeah, I was going to say, so Tim Cooley invited me to join him on his podcast.
Mm-hmm.
And this is, I mean, he had something called pitchus.io. And the cool thing about this is that we're taking, founders that are trying to create their pitch decks, and it gives them, one, an opportunity to present to real investors. And then two, to get feedback on their presentation and their pitch deck. And so, it gives them those benefits. But then the thing that's really cool about it is that we're now putting this out in terms of, I think we've got like 25 episodes now. Not all of them have been released, but now other founders can go in and watch other founders pitch and then look at the feedback and that they receive on their pitch decks. And I mean, it's super helpful for early stage founders to just be able to learn from the mistakes or the things that other founders do really well, and then take that and incorporate that into their presentation and into their pitch decks.
That's great. I was wondering, first of all, you said it's still a podcast, do we listen to it? But secondly, how do we get our participants, our attendees here today? How do we get them on there to pitch and get that feedback?
Good question. You can go to pitchus.io and apply. Tim takes care of kind of the screening process and that, but I know we were booked out pretty far now, out probably into November, but I think we're going to try and open up some new slots in there as well, just because we've had so many founders reaching out wanting to practice their pitch and get some good feedback.
That's really great. That's a really cool idea. And I love that you can go in and just listen to other people. They might be in a similar situation to you. So you don't necessarily need to pitch yourself, but if you can find a similar one, you get great feedback. But also, what a cool idea. What a cool interest. We did get a couple of questions come in, and then I also have a ton left. But Shane, you're asking if the presentation will be shared afterwards. So this whole thing is recorded and we'll have it posted, and we will send it out to everyone that that registered their email on the Zoom. So this will be sent out to everyone, and you'll be able to access the whole video recording. So you'll have the slides, you'll have Jeff just dropped all that knowledge. You mentioned all those different companies, and you can kind of screenshot or pause or whatever you need. So that is hopefully a good answer for Shane. Let me know if you have any other questions follow up on that. And then we have one, please talk more about why having a solid financial model and why when you have pivots, you need to update the model.
Oh, great point. So having a good financial model becomes so important for founders. One, for preparing for raising capital, just to know how much you need to raise, when you need to raise it, when you're going to run out of money, things like that. But there's a good point made here in this question is, when you pivot your business, your financial model is going to help you drive some of those decisions. So strategically making decisions like that of when to pivot or what to pivot to. So a good financial model is going to show you, you can run scenarios, for example, of what happens if we doubled our, advertising budget and we put more into paid click ads. What's going to happen ultimately if we put more money into this, as opposed to putting it into hiring more salespeople, or, maybe we hire 3 more SDRs, or, which scenario is going to be better for us? Should we keep going down this model of spending more and more money on paid ads, or should we go invest in more SDRs? Well, based on your historical, financials, you'll be able to start to see trends of saying, okay, when we bring on a new SDR, this is what we can expect. Here's the cost associated with it, and here's the revenue that ends up resulting over this period of time. Well, you can run that scenario and see what does your business look like in, a year, in 2 years, in 3 years, and then do that same model and say, okay, instead, what if we put all this money into paid ads? What happens then? Which of those scenarios is better? And you're not going to know just anecdotally by guessing. You need a good financial model to kind of give you some of that insights, where it's going to tie in your costs and the different impacts that it has on different pieces of your business. So your financial model will not only be updated when you pivot, but it will help you make decisions on what to pivot to. Just to kind of wrap up this question, when you do pivot, you're going to want to make sure you update your assumptions. And the more data that you have historically, the better your financial model is going to get. Because let's say that you come in with an estimate that your customer acquisition cost is $5 per new customer, and you get into this, and the last 3 months you look at it and it's actually more like 10. And so, that's where you're going to want to be updating your financial model and going, okay, what does that mean for us? Does that mean, that we're going to have a viable business even, or do we need to pivot? So, and vice versa, if your customer acquisition cost is trending down, you might start impacting those, or changing your forecast to influence that. And you might end up saying, we don't need to raise as much money as we originally thought we did. So different assumptions that you start to hone in on and get better and better with the historical data can have a real impact in terms of your decision making when you run it through your financial model. Excellent question.
That was great. Great answer. I had another question. You talked about the importance of a startup attorney, and I completely agree. I am the type of person that I know I'm really smart in this category, but I need help in others. Like, I think that's one place you need to hire, right? I imagine it's much like when you're buying a car, right? You want to ask the right questions. You're buying this used car, you need to know exactly what's going on. What are the right questions to ask to make sure that that is the right startup attorney for you? And I guess it might be true of all like contracted like work, like accountants or consultants or anything. What are the questions you want to ask?
Well, first off, I would probably talk to other founders and get their experience, and ask who they're using and what kind of experience they've had with their startup attorney. Having a referral like that becomes really helpful, because now you've got somebody that you know and trust that is recommending somebody that's worked really well for them. And now granted, you want to make sure you've got a similar business and that there's a good fit there, but talk to other startup founders and get their experience with different attorneys. So that's one thing to ask. But as you start to interview different startup attorneys, ask about their experience in terms of raising capital. If you're going down that path of raising venture capital, how many deals have they done? How many clients do they have that have raised a Series A? How many have raised a Series B? Have they taken them through that process? How many have IPO'd, if that's kind of the track that you're going down? Asking the questions that, to kind of gain their experience, because you don't want an inexperienced startup attorney working with you. Yet they might be less expensive, but actually they might be a lot more expensive because you end up having to clean stuff up. And so just really honing in on their experience, and then, we're asking about some of the clients that they've worked with. In fact, it's very appropriate to ask for references. It's like, hey, I'd love to maybe chat with some of your clients that work with you. That's very appropriate. I mean, your startup attorney wants to make sure it's a good fit as well if they're a good startup attorney.
I love that. I think that's great. I think a lot of times it's just having the confidence to ask questions that you might feel uncomfortable asking. And I agree with you. Do the work correctly the first time, and it'll save you so much headache. It'll save you so much money and time in the long run. So I think that's really solid advice, and very important to do the homework up front.
Yep.
We did have another question, and it's kind of a like one of the questions I had as well. So hopefully it'll kind of go together. But my part was, how do you know when you're ready to go through each series? But then one of our guests also asks, I'd love to hear Jeff's thought on Series B as the company is ready for critical mass. Is the main driver a revenue metric of 10 million plus and solid leadership team and consistent growth that lets you know you're ready for Series B? Industry-wide, this is an area where there's not as much guidance from experts like Jeff.
Yeah, great question again. And I won't say that I'm an expert in Series B companies and beyond. I'm probably more versed in some of the earlier stages, but I will say that when you get into raising a Series B round, it is a different ballgame. You're dealing with different level of investors. You're also dealing with higher dollar amounts typically. You're also, not all Series Bs are the same, and not all Series A's or seed rounds are the same. Depending on the sector you're in, I think the question threw out a revenue target. Is $10 million the right revenue target to kind of say you're ready for a Series B? Again, it depends on your industry and what the benchmarks are. There's some great data out there. In fact, Carta has some excellent data in terms of what the typical Series A looks like, what a typical seed round looks like, just to give you some general, benchmark data. But again, going back to having a good startup attorney, if you've got a good startup attorney, this is what they do every day. They can actually tell you, okay, the last Series B that I went through, this is how we priced it, and this is kind of the metrics that we saw. There's another company out there, a local company here, that you should all know about is Omni. And Omni is teamed up with the National Venture Capital Association. And they put out a fantastic report with some benchmark data on, what different series look like. But they've got data that can actually even tell you when is the right time to raise your next round. And so kind of going back to this question of, based on data and benchmarking info, is $10 million in revenue the right time, or should you raise when you're at 12? You can drill into some real amazing data out there that companies like Omni have and actually make available. So that I would say do your research. And again, I would also tailor it to the type of company as you're benchmarking. $10 million might be a great target for a certain type of company. Whereas, if you're a biotech company or something that's going to be irrelevant, you're probably not going to have, it may be more other different benchmarks other than revenue that factor into whether you're raising a Series B or when the right timing is for something like that. Hopefully that gives you a little bit of at least some resources to maybe look at. Like I said, check out Omni and the NVCA data. Also, PitchBook puts out some great quarterly data that you can kind of drill into to kind of see where, if it's SaaS companies, look at where the revenue multiples are and what it looks like. One other thing I'll mention, he's mentioned having a solid team. When you're getting into kind of that Series B and beyond, instead of having a plan and being, thinking that, okay, this is the team that we're confident is going to be able to execute on hopefully this plan and being able to pivot when we need to, you start to evaluate the team a little bit differently, saying that, okay, now we've kind of proven that we've got product market fit. We're seeing that the revenue is ramping. Now, is this the right team that's seasoned, that has actually taken this to the next level? So if it is a $10 million kind of company right now, is this the right team that can now take this to 50 million, 100 million in revenue? And that could be a very different team than what you started out with at your seed or Series A level. And so building out that team and giving you, again, it goes back to confidence. Do the investors have confidence that you've got the right team in place that can now execute on this next level of building the company?
This is a great question and a great answer. And I think it's so great of you, Jeff. You're a really good connector. Like, I think you're so great at, these are the resources you need. Look it up here. Look it up here. You just know so many resources that are out there. So I do think it's important for everyone to go back in the recording and just look at that big list that you put out there. And I put a couple in the chat that he mentioned that I don't know if they were on the slide, but it's super helpful. It's great information.
Well, the other thing that's really cool is there's a lot of cool companies here in Utah that have products that help early stage founders as well. And so being able to have some of these resources and some of these great companies in our backyard is really cool. We've got a great environment here. Absolutely.
I mean, it's huge. Startups will never go away in Utah. We'll always have startups. So you're just like a capital of them. It's great. And so I love that there are so many products and services out there that are local that people can use. There is another question. So you talked about like the importance of having the ask slide and the importance of kind of tailoring your pitch to your situation, to your audience. Is there across the board, apart from just the ask slide, are there other slides that you, no matter what, need to get in your pitch deck? If it's a 3-minute, if it's a 5-minute, if it's a 10-minute, whatever, are there other just absolutely vital that you have to have in there?
Yeah, I would say the ask slide is critical. Make sure you have an ask slide so that you're actually, in fact, that's the one that gets looked at the very most. Leave it up on the screen while you're talking, opening up for Q&A, because that's going to get referred back to, and know what you're asking. It's like, hey, we need, $600,000, and this is what, and in order to get us from where we're at right now to this point, and here's what it's going to be used for. And here's the traction that we've already got. We've already raised, $300,000. We need 300 more. All of that stuff can be on your ask slide, and that becomes very important. So definitely make sure you've got that. I'm blown away how many times that gets left off of a pitch deck, and you just go, why? The other one is your team slide. I mean, especially early stage, investors want to know who you are and is this the right team? The credentials and credibility of your team is going to be a big impact or influencer on the confidence that the investors have. I mean, you've always got I think the other slides, I mean, you hear about having the TAM slide, the market slide, how big is the opportunity? That and the financials, a financial projection type slide, or kind of where you're projecting your metrics to be. One shows traction. So if you can show traction that you've already got some revenue and where that's trending and where that you expect that to be, that becomes very powerful. But going back to the market slide, that combined with your revenue projection slide should convey that this is a huge opportunity. And I mean, you can get into pitching to different groups. If you're talking to a VC firm, you have to convey and provide them the confidence that this is a huge game-changing type of an opportunity. This could return their entire fund if things go well. And so getting that message across in your pitch deck is essential if you're pitching to a VC. If you're pitching to an angel investor, I mean, again, it goes back to know your investor. Maybe you're pitching to a family office or an angel that if you have an exit in 3 years and you get you triple the valuation of the company, maybe they're super excited about that. A VC isn't going to be super excited about that, but there might be certain investors that would be, and maybe that aligns better. So knowing your investor will also help you determine how to present things in your pitch deck. But regardless, you're going to have to show some of that. If you can show traction, make sure you know what you're asking, make sure you're hitting on your team. And then you can get into some ancillary things where, do you know the competitive landscape? How familiar are you with the market? And, and then anything you can do to kind of create credibility for you as a founder and the space, your knowledge of the space is helpful.
That is really helpful. And I think, yeah, definitely your team, that's great that's the one you would really stress, is just your people. The people is what makes the company. And even some of the huge behemoth companies that we talked to at Utah Business, when I was asking them, what is it that makes your company so successful? The number one thing people always bring up to me is our people, even these huge, huge, huge companies. So it's just so important. It's like the number one thing, get it started right, get it started early, and just, have the great people, promote your great people, tell everyone about your great people.
Mm-hmm. Yeah.
At the event, we will have the chance to listen to the pitch competition, right? And our companies that will be pitching during that competition will have 4 minutes to pitch. After that, we have something separate. That's our office hours, where people have 10 minutes one-on-one with these investors. What do you expect to be different in the 4-minute pitch versus the 10-minute pitch? Like, what do you think will be the main differences there? How do you prepare for one or the other?
Man, excellent question. It goes back to making sure you've got, multiple pitch decks and pitches ready to be able to present for different formats. Because like I said, I suggested a 3-minute pitch. Well, this is going to be a 4-minute pitch, and you need to be able to practice that and make sure that you've got that down. So what's the biggest difference in your 4-minute pitch is that you're going to have to be very concise. Make sure you're not rambling on, because you're going to hit the buzzer and you're not going to even get to your ask slide, right? You're going to be talking about the problem still, and the buzzer is going to go off, and you're not even going to get to what you need to get to. So the biggest thing is, you're going to have to quickly identify the problem and make sure that everyone understands the problem, and it's kind of dumbed down so everybody can understand what is the problem that you're addressing, and then go into the solution and make it articulate. This is how we're solving the problem. Don't dwell on it too long. Too often founders will get caught up because they've created this great product or service or software that solves this really difficult problem, and they just want to start talking about their product. And it's really easy to do because that's what they're passionate about. And so they start going into their product, but they spend too much time on their product. For the purposes of the pitch deck, we're going to trust that your product is awesome. It's going to do this. And hopefully it's validated by some customers that are using it. And we want to see some traction, and we want to see where that this is a good size market that you're going after, and hit that real quick. And then demonstrate that, like I said, you've got some traction and your numbers very quickly. And then, what you're asking for and what it's going to be used for, and how you're going to get to your projections of what you're talking about. So make it concise and clear and practice it.
Yeah, great advice. I can't stress enough the importance of actually practicing something out loud. We often do things in our head, and this is how I would do it. Once you get up there in person and you actually start opening your mouth, it's a whole other ball game. So
For sure.
Having that muscle memory, speaking it out loud, how you would actually do it, I think sets you up for the best success. Jeff, I noticed you have this screen up, and I was going to ask, so you mentioned a few things. You let 25% off your services for the first year subscription, and you have free templates and financial models and everything. Is your email the best way for our attendees today to get a hold of those awesome resources?
Yeah, absolutely. You can definitely email me or connect with me on LinkedIn. I will say my LinkedIn messages get flooded, and so I'm very slow to get back to them. Sometimes things get lost in there. So email is probably more a better solution if you need something right away.
Yeah. Well, I don't see any more questions, but if people do have questions, don't hesitate to reach out. We will send the recording of this webinar out, as well as the promo code for the event next Thursday. Come meet some investors, watch a successful pitch, have a great time and learn so much, but also just make connections. And Jeff is a great connection for everyone to have. He is a great wealth of knowledge resource, but also a connector. Like the number one thing I know about Jeff and that I appreciate the most about him is he will connect you with the right people. And it's so helpful and he's so kind. So Jeff is a good guy to have in your corner, everyone. So make sure you make that connection with him.
Oh, thanks, Nicole. Appreciate it. Too kind.
Oh, well.
No, we're super excited for the event and looking forward to seeing you there. So it's
Yeah,
next, is it
it's
Wednesday or
next
Thursday?
Thursday, a week from
Next
today.
Thursday, a week from today. Love
Yep.
it. Okay,
Perfect.
well,
Yes.
excited to see you there along with everybody else. And how are we going to get the promo code out to people? Do you want people to contact me or did you share it?
I shared it in the chat. They can also contact you, and I will also include it in that email with the recording.
Fantastic. Great. Thanks so much, Nicole. This was awesome.
Welcome. Thanks everyone for attending. Thanks, Jeff.